get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey, welcome back to the Financial Purpose Podcast. I'm your host, Dale Schaefer. This is episode 89. Ticking closer and closer to that 100th episode, and it's going to be fun. So, just 11 more, 10 more. I guess this is the 11th, so 10 more episodes to go. You can do the math at home. Anyway, we are continuing the series, breaking down the BOSS method, which is the financial planning approach for business and personal wealth management at Life Moves Wealth. And the past two episodes, we worked on the B in the BOSS method, which is build, which is where we're laying the foundation. Last week, we talked about the O, which is optimize, and that's where once we have the foundation, we're starting to make everything around it function better and kind of tying personal and business things together, separating expenses and cash flows and starting to kind of put together objectives and plans and goals and things like that. And so today we're going to talk about the first S, which is secure. And this is where we do a lot of really detailed strategic work on the business, on you as the business owner, on your management team as operators. You see what I did there? I made the management team operators and I made you the business owner. So you have graduated to an investor in your business. And so now instead of looking at the business from the line of sight, we're going to look at the business from up above and see what's going on. And that's how we secure it. So again, the BOSS method stands for Business Owner Strategic Success. It's a two-way acronym, and there's build, optimize, secure. Today's episode is on secure, and then next week we'll talk about succession, and we'll wrap up the explanation of the BOSS method. But the reason that the BOSS method came to be is, as you've heard me say the last couple episodes, is I've started to work with more and more business owners. And the one thing that I've realized is as I attract new business owner clients and I continue to pursue other business ventures myself, because I do have a couple of other businesses outside of Life Moves Wealth that I'm involved with. And the more that I do those things, the more that I understand that business owners are not at all like traditional investors. And so the typical financial advice model of, hey, bring all your money over, we'll manage it for you, we'll buy these mutual funds and these ETFs and these stocks and these annuities, and here's a life insurance product that you don't need, but we say you need, right? Because life insurance is where wealth management often gets abused, and in my opinion. And so, it's really easy to sell those. There's a lot of commissions. It's really easy to sell annuities because you get the guaranteed income stream for life. Plus, there's a survivor benefit, and those are easy to sell because, no brainer. I mean, we just put your money here. It grows. It's safe. It pays you an income, and the advisor gets a massive commission for those. So, that's where that happens. So what I realize is that for most business owners, the conversation usually stops at, hey, bring us all of your assets and we'll manage them for you, because a lot of time business owners have put so much money into other things like their business, like their personal real estate, like cars or adventures. A lot of the business owners I talk to, especially in their 50s and 60s, they'll say, we've made a lot of money, we've spent a lot of money, and we enjoyed ourselves. We just didn't save a lot of money. So now we're kind of playing catch up, and we need the business to be able to fund the value gap in our retirement plan. And that's true of most business owners. So for most of us, the business equity and value represents 50 to 80%. Anywhere in that range is usually what I see. And it's usually closer to that 70, 80%. But 50 to 80% roughly of our net worth is represented by the value of the business. And that is a very high concentration in one very specific asset. And there's a lot of risk there. So that's why we're going to work on the secure letter today, and that's why this is the strategic and detailed part, because there's a lot of things that we do. So let's go ahead and dive right in. So in the secure phase, we've already laid the foundation. We've already started to make things work better, more efficiently. We've done all the work to separate personal and business expenses. We're optimizing cash flow, all of that. Now we're going to work on things like there's several key areas, and I'm going to go through those. First key area is we're going to develop strategies to scale the business while maintaining financial stability. Now that, if you're hearing it, I'm hearing it as I say it, is a lot of word salad. So let me break that down. I'll say it one more time. We're going to work on how you're going to scale the business, develop strategies, while maintaining financial stability. So we can't grow. You can't jump without a stable platform, right? Have you ever tried to jump off from something with wheels? It doesn't work so well. So you have to have a stable, optimized platform to be able to then build on or jump from or continue to take the next step. And we have to make sure that the financial backing is there for the growth to occur. So growth is exciting, but without financial discipline, growth can become a liability. So scaling your business should be very strategic, and it should function like a plan, like something that you can execute because it's already been defined and written down. It should not be chaotic. It should not be people all over the place, processes, loose processes everywhere. So you have multiple people stepping on each other's toes, trying to get the work done, or trying to take credit for projects, or trying to sell the next level of work. Or you might have one client that gets phone calls from two different people and there's a disconnected process. That happened to me last week from a vendor that I worked with. Two different people had reached out, and they did not know, each of them did not know that I was the common link. And so it's very important to have a united front in your business, and the way to do it is to, if you're going to scale, especially, and as you're scaling, things do get chaotic. So it is incumbent upon you as the owner and the operator and the investor to be able to pull all those things together and try to get that ship running as tight as possible. Even though there's going to be room for chaos. There has to be room for chaos. Chaos is the next level of development. It's the next level of innovation. But you have to have some controls around it, because then the chaos can actually tailspin you out of productivity. So we want to build systems that grow with the business. This is where the art of chaos and order kind of playing together, because your processes need to scale as the business scales. You don't want to grow and then go back and say, hey, since we've grown, let's put some things in place. Go ahead and start, begin with the end in mind, start there, and then start to scale things, change things, move things around, eliminate a process, introduce a new process, whatever that looks like for you. And again, I want to say this, as a financial advisor, I'm going to stay in my lane in this stage. And in this stage, it's especially hard because I have a lot of real business experience. I have a lot of financial experience. I have a lot of operations experience. I have GM experience. I have P&L responsibility, but I'm not an operations consultant. I'm not a CPA. I'm none of those things. So when we get to the stage, if I'm looking at how you describe your business, or if I'm in your office and I see chaos, I'm going to recommend that we call in one of my friends who is an operations consultant, and they're going to help you do this better. They're gonna walk you back to the optimized stage and help you figure out your processes and what needs to change, what needs to be implemented, and how your forms are filed, and what order and where the baskets are, and all whatever those things are. Somebody else with that mindset is going to help you, and I'm going to still financial stability. That's my role. So just want to have that as a caveat there. Now, speaking of my lane, as you're growing, you have to have realistic financial forecasting in place. And you have to do this so that way you don't run into a gap of what you expected to have as cash flow and revenue versus the reality. So, as an example, I learned this lesson very, very early in my career. I was 22 years old, and I took over as branch manager for the regional mortgage company that I worked for. So my very first professional job, I was a loan officer in a regional mortgage brokerage. This was back in 2003, 2004. So this was the refi boom. Rates had just come down. That we were then Fed chair Greenspan. And so rates were low. We were coming out of the recession. We were coming out of, the tech bubble. We were a crash. We were coming out of 9/11, all that stuff. So there was some stimulus happening. Rates were low. People were borrowing. It was a great time to be in that business. And so that's how I learned about money was that job. And so branch manager walked out and I got tapped on the shoulder. Because I was very good at my job and closed a lot of loans and had great reviews from clients and had a lot of referrals. So I had reached a point within about 8 or 9 months in the business where I was taking almost no leads. And at that point, it was the telemarketed leads, which was really crazy because somebody would call your house because, cell phones, not everybody really had them, even in 2003. And somebody would call your house while you're eating dinner and they would say, hey, would you like to refinance your house? And you'd go, well, I think. And I go, well, what's your interest rate? And you tell them your interest rate. And then you would give them your name, your date of birth, your social security number, where you work, how much you earn, your spouse, your kids, your home value, all of that. You would just give them all this information and they would compile it and then they would fax it. They would fax it into our office. And then we would call them. So if you've ever seen the movie Glengarry Glen Ross, it was kind of like that. The leads are weak. The leads aren't weak, you're weak, right? So I can quote most of that movie. Anyway, that's what it was like. And so we would get a stack of leads and the branch manager would look through them and kind of cherry pick what he thought were the good leads for the people who were doing better work and closing more loans. And then everybody else would kind of get whatever was left over. And so I had reached a point where I had a lot of referrals. And so I was taking almost none of those leads because my clients were just referring me. So every time I would close a loan, I would leave the closing with 2 or 3 other people that my clients wanted me to call that they had already talked to. It was a warm handoff. And so by the time I called, they were like, yeah, we've been expecting your call and we'd love to talk to you. So that's how I did that. So I got tapped to be the branch manager. And I'm on my very first sales call with all the other branch managers in across the country for this company, and it got to me, and I was in South Bend, Indiana, and so I remember our ops manager said South Bend, and I said, yeah, our projected revenue for the month is X, and we're at X, which was well below. And I remember his name was Jim. He said, Dale, how are you going to do that? And I said, we're not, we have 2 weeks left in the month. We don't have the pipeline for this number, but this was the prior branch manager's number. So that's what I'm reporting. And he's like, yeah, no, change your projection because we can't run the business on a projection here and have you way under deliver because that is what is going to happen. And then it looks like we just have a big miss. It's going to make everything look wonky. Later, when we're reporting a year from now, we won't remember how that happened. We'll just see a big miss in the projection. So you have to have realistic financial forecasting in place. And if you're going to miss a goal, I hear people say this all the time. They're like, never downgrade your number. And I say, give yourself a reasonable and realistic target to hit. And if you undershoot it, it's going to give you a lower comp the next month, the next quarter, the next year, whatever. So then at least okay, this was a miss. We learned some things, and now we need to overshoot that so we can bring the comp back up. So there's nothing wrong with carving your number down to where it's supposed to be from a projection standpoint or where it's going to go. Because as a business owner and even as a sales leader, as an operations, as a financial person, whatever your role is, we've got a pretty good gut instinct on whether or not things are going to come to fruition. And it's awesome when we get surprised or when somebody just hits something out of the park, and all of those things are great. But be realistic about it, because it's going to matter when you look at your numbers later. Um, you need to, as a part of that, also assess what kind of capital needs you're going to have. Are you going to need to borrow money? Are you going to need to ask for an injection from an investor? Are you, as the owner, going to have to inject capital into the business for the next stage of growth? But you need to anticipate what that's going to be before you need the money, because you want to avoid overextending yourself by taking on a bunch of debt if you don't have to take on debt for the business. Now, sometimes the role of leverage is very important and very helpful, and leverage can increase your returns in the business. And so if it's managed correctly, leverage can be a good tool for how you build wealth, for how you manage the next stage of your growth in your business. But it has to be managed well. You have to know what your capital needs are. You're going to have to know how long you're going to be, you're going to have an outlay of capital to service the debt. And you just don't want to get upside down there, because there's a point where the scale tips the other way and the debt is hard to overcome, because then all you're doing is you're making interest payments. So you're going to be like the federal government at this point. You're only ever going to make the interest payments. The debt's going to continue to grow. The interest payments continue to grow, but you lose the ability to regain any equity and any working capital, because it's all going to go out to debt. And that happens in business. And that's usually when we see businesses go out of business. And it happens on the personal side too. And that's where we see people selling assets or filing bankruptcy, or just lowering their quality of life because they've overextended and they've got nowhere to go. So they need a big windfall, and a big windfall introduces poor behavior around financial management. So there's a delicate art there. We have to maintain a balance between reinvestment and preserving liquidity for operations. So what I mean by that is you have to have liquidity to run the business. You need to have working capital that actually can be worked. Go back to the episode, I forget the number now. I want to say it was like maybe 80, 79, 80, 78, somewhere in there, where I had my friend Abran Villegas from Lazier Capital on. We talked about the role of working capital in your business and how you can manage it, how you can grow it, how you can scale it, how you can be strategic with your receipt of income and your payment of liabilities and invoices and things like that. And so you want to keep a cash reserve, because there are times where your working capital is going to expand and there are times where it's going to contract. The cash reserve allows you to fund minor things along the way. And you can work this, you can think about it just like we do in personal planning. It may be a number that you're comfortable with in your business. So you may say, I want to have a minimum of a operating cash reserve of $50,000 or $100,000 or $2 million, depending on your business and what you're doing. And, or you can also go and say, okay, I know that our monthly outlay is X number of dollars. And so I want to have at least 1 month of outlay in the bank in case we have a bad month and we need to catch up. You might do that for 2 months or 3 months, whatever it is. So at some point, though, we want to make sure that your cash reserve is optimized, because too much cash, especially if it's sitting in a no yielding or low yielding, I like to say no yielding account, it's like sitting on dead money. And in fact, it's losing value because of the natural rate of inflation. So we want to do that. Have your cash reserve where you can get access to it, but you also want to build additional capital in a separate account that can be used for reinvestment or other large planned capital needs. And so, for example, if you know that in a year you're going to need a big pile of money to do a down payment on the next project, or to start the next phase of growth, or to buy machinery, or to introduce a new product line. So you've got to fill up with inventory, or you're going to bring in a new inventory management system, or any of these number of things that we do in business. You want to have a separate account that has the ability for yield. Now, you don't want to put short-term money, so anything a year or less, and frankly, sometimes even 2 years or less, you don't want to put that at great risk of the market. And so you're going to want to have some sort of higher yielding short-term debt. And so you might have, a bond ladder, which is where we have some bonds that mature in 90 days and some in 6 months and some in a year. And maybe we have a part of it in a 2-year CD or something like that. So we want to have things that are somewhat capital preservation minded, but also give you the ability to earn a little bit of money. And then if you're crazy and if things are going well, then maybe you put a small portion into the S&P 500 or some other investment like that. And but that's going to be a smaller portion, because you don't want to put the money that you need at a very specific time frame at risk of loss, because you're going to need the money. So you want to have operating cash in one account. You want to have investment cash in another account. And then all money always needs to be assigned a job, because every dollar is an employee. Those employees, if they sit in a bank account, get very lazy, and they don't bring you anything back, and they don't bring you any return. They don't bring you revenue. They just sit, and they're very, very lazy. So every dollar needs a job. Those jobs are very, very important, and you want to make sure that you have that assigned. I like to think of a dollar as like, when I have a dollar and I put it somewhere, I'm asking that dollar to join a cult and go get followers and bring those followers back to me, because I want money going out to collect more money when it comes back home, and that's very important. So the last way that you bring all of this together, to know what you need the money for, to know what you're managing, to be able to set your forecast correctly, is to have KPIs in a good KPI dashboard. So again, key performance indicators. Have a KPI dashboard so you can track growth, you can track progress, you can track statistics in your business in real time, and you adjust them proactively. So you're seeing things happen as they're happening in real time, rather than getting a report card at the end of the month and realizing you missed all the opportunity. So you have to be able to watch this. Go back and listen to episode 80, which is where I talked about managing KPI dashboard, how to set up a KPI dashboard, how to know in your business what type of KPIs you might be looking for. And if you have questions or want suggestions for your business or to build a KPI dashboard, reach out to me, and I will either connect you to an operations consultant, or I will say, hey, if you have this kind of business, look at this, and this. Just send an email to info@lifemoveswealth.com, put KPI dashboard in the subject line, and I'll be happy to talk you through that. Or again, get somebody in who can help you put hands and feet to what you're trying to accomplish. Okay, the next thing that we're going to work on, so that was all, that was a lot, and that was all in just the developing the strategies to scale the business. So now we're going to identify opportunities for reinvestment into the business and to start building personal wealth in the process. To do that, we have to prioritize reinvestments that improve your efficiency, they reduce your cost, and drive predictable revenue. One of the best investments you can make in your business, especially if your business is highly transactional in nature, and a lot of service-oriented businesses are, a lot of product-oriented businesses are as well. The best thing you can do is to figure out ways to create some sort of recurring revenue. And there's all sorts of little ways that people do this. I mean, if you think about your car wash, it's easy to go through the car wash. You pay the $15 or the $22 if you get the Canuba wax, and you go through the car wash. Well, they say, hey, for only $30, you can come any old time you want, all month long. Just put the sticker on your window and drive on through. And you're going to say, because I often do, say, nah, I'm good. Like, I just want this one car wash, and maybe I'll come back in a month or so. And they're like, really, though, it's really convenient to just come when you want. So what they've done is they've taken a very highly transactional business, a car wash, And they figured out a way to have recurring revenue, which is you get people signed up for these things. And like everything else, we get signed up for them and then we forget to use them. And we're just paying the thing. Netflix figured out a way to monetize heavily a recurring revenue model with a monthly membership. And so gyms do the same thing. There's all sorts of ways to do this in your business. And I was thinking about this yesterday. I was like, my truck's going to need an oil change pretty soon. That's very transactional. But what if the automotive business created some sort of a monthly or a yearly maintenance care plan where you pay, a few $100s a year, and it works like a deductible. And so you just take your car in and, if it's under whatever you paid for the year, perfect. You don't have to pay for anything that day. You just get your oil changed, get your, your belts changed, your filters changed, whatever. And then you just go about your business and it's a service that you've already paid for. So there are all sorts of ways to do that in just about any business if you get creative enough. All right. The next thing you want to do is separate operational capital from growth capital. I just mentioned that earlier. Separate accounts, they allow you to operate and stay within your forecast, save and invest for future growth. I highly recommend for this. If you haven't read the book Profit First by Mike Michalowicz, do that. The book Profit First and the methodology in it will tell you how to do this the right way. There's a very specific process for how you receive revenue and then where it goes. It goes into other accounts for very specific purposes. And it forces you to be very efficient with your capital. And as a part of the process, if you're doing it all the way through, it forces you to save in a place where you're not accessing. And that can be very important. So Profit First, Michael Michalowicz, look it up. Fantastic book. Or, as I've said earlier as well, hire an operations consultant who has read and understands and implements the Profit First methodology. Or if you have a CPA that is a Profit First believer, they will help you implement it as well. So just find somebody who's read that book. I, of course, have read the book. I run Profit First in both my personal and my business financial lives. And so I can also help you understand the methodology. So just find somebody who does it, has done it, is going where you want to go, and you'll be set up perfectly. This is going to also help you know when to reinvest in your business versus when to invest outside of your business. So what you're learning to do here is diversify away from a single point of failure. Or another way to say it that might be easier to wrap your brain around is we're going to diversify your assets, move some of the money that you're building for your personal wealth out of the business and start putting it into other places. One of the easiest ways that we start that process is we take money from the business and we start a retirement savings plan for your company. So your employees benefit, you benefit, and it's also pulling money out of the business. It's tax preferential, and it goes into a forced retirement savings account for you and for your employees to participate in. So that you start diversifying the asset. And then there are other ways that we do this as well. But we need business owners to diversify their risk, to diversify their concentration of assets. And we just want to get you out of single investment risk at any point that we can. So if you're, for most just people who work a job, they earn a living, they put money into a 401k, they own a house, they're saving for college, all of these things. For them, their single point of failure risk is their house. Because for most people in that world, the value of the home represents a significant portion of their financial. And so sometimes we have to look at other ways to be able to save or to build capital or to buy investments and other things. So that way they're diversifying away from the risk of that home. And there's a lot of risks that can happen with the home. Of course, that's insured. So there's a little bit of a reduced liability risk there. But, if you lose a job and you can't make the mortgage payment, you've got to sell that asset or you're going to foreclose on the asset or something like that. So that's where the risk is not being able to continue to fund the needs of that asset, or the home can go in disrepair and then you lose the value, or you can have the neighborhood change over time, and then the value of your home is affected one way or the other. So we just, anytime that we have a single point of failure in our wealth management plan, we want to diversify it and move the risk to other places so that way it's a little bit more spread out. And then the last thing that we want to do when we're identifying opportunities for how we reinvest in the business, how we build the personal wealth side of that, is to coordinate the tax plan to identify timing strategies for reinvestment. A good CPA and a good financial planner will sit in a room with you for several hours and talk through your business plan, talk through the next level of strategy, talk through timing, talk through tax impact, talk through income receipt, talk through whether or not you need to defer income or bring it all in, or bunch deductions, or spread them out, whatever. And I say this because I just did this last week with a client in another state. So I flew into the town where they live. Their CPA flew from a completely different state into the town where they live. And clients, husband and wife, CPA, and me holed up in a room. We rented a co-working space in a room for about 5 or 6 hours with whiteboards, with our laptops, and we did math, and we talked through strategy, and we talked through some of their business complication and partnership arrangements and things like that we need to start working on over the next 6 to 12 months. And then we wrote out their 5-year plan. And then we said, okay, these are the things that in 5 years we want to accomplish. Now let's set the next steps for how we start to build the foundation to accomplish these 5 things. And it just took a lot of time. You need somebody who's going to be able to do that. And frankly, I would rather sit in that room with you, the business owner, for 5 or 6 hours with the CPA and maybe an attorney and maybe your partner, business partner, or management team, whatever. I'd rather sit in that room and do that kind of financial work than to be on a phone call and talk about rate of return over the past year, because it's rate of return is what it is. When we're talking business strategy and financial strategy, that's your real life. You're putting things in place. The market's going to do what the market's going to do. And if we believe in our investment strategy, it's going to go up and it's going to go down. It just is. And so it's more helpful to look ahead and say, I know that asset over there is running this way. I know that my real estate is the value. If you had the ability to see the change in real estate value on a day-by-day basis, I think it would drive you crazy, because you would be on Zillow or Redfin or Open Door or whatever other site, and you would want to see the day-to-day changes. Oh no, did the market move? Oh no, did my value go up? Did my value go down? And that's how people treat their investment accounts in the stock market and the bond markets, when some days it's going to go up and some days it's going to go down. And it's not because we have bad investments. It's just because of the market dynamics. This is how an efficient market works. It just moves on its own. So anyway, it's more interesting and more helpful for us to sit in a room, talk through your strategy, help you build assets, help you be financially strategic with how you do your next level of growth. And this decision that we worked through with this client was very complex. And it's a very, very, it's a risky business move, but it has the ability to really do amazing things for them personally and for their business and for their employees. It's going to create additional jobs. I mean, it's going to do a lot of really cool stuff. That's where we have fun, because now we're accomplishing things in your financial life that is more than just the stock market, or more than just business revenue, or more than just real estate, right? We're tying all those things together. So find people, work with people who are going to do that with you. And I'm that financial advisor who will do that, because I know that you're going to build an awful lot of wealth, and I get to be part of that journey, and that's going to be really cool. And so let's do it together. All right. The last thing here. Nope. Sorry, not the last thing. I'm going to try to speed up the plane here. All right. So we talked about strategies for scaling. We talked about opportunities for reinvestment. Now, as a part of sitting in the room for a long time and doing strategy, we're going to now secure and build out a diversified wealth plan that protects against over-reliance on just the business. As I was saying a few minutes ago, we need to diversify from a single point of failure. This is the reason that we must. There's no way around this. I'm throwing the gauntlet down. I've been very clear, and I'm going to be very clear again. This is why we must manage personal financial planning and business financial planning together. They need to run a concurrent course. They have to be considered together. You cannot do one without the other. The old financial advice where they just say, what's your business worth? Okay, cool. I'll put it on the piece of paper and then I'll project it for 30 years. And, then at some point you'll sell it and then you'll be a millionaire. It'll be fantastic. That doesn't work. It can't work because I can't give you advice that involves your business because that's where your income is sourced from. So any advice I give you financially involves your business. If I don't know what's happening in your business, and I don't know if the advice I'm giving you is if you're capable of doing it because of how the business is running or not running, we're going to have conflict and you're not going to get to where you want to go. And then I'm going to say, gosh, what'd you do? Or, oh man, I really wish that business would have sold for more. Gee, what happened? Weird. No, let's know what's going on in both worlds and tie them together. We can't. It's like malpractice. I look at it this way. It is malpractice for a financial advisor to only manage your assets if you're a business owner and not dig into what's happening in the business. Because if we consider your business as an asset, shouldn't it be managed? Right? I mean, you have to have the complete picture, and this is very important. So we're going to set personal savings goals outside of the business. It's going to be tied to your life priorities, and then we're going to bring in your exit strategy. What's the timeline? Who do you want the business to go to next? What would be an ideal transfer for you? Do you want to sell it to a third party? Do you want to sell it to private equity? Do you want to go public? Do you want to put in an ESOP program for your employees to own the business? Do you want to sell directly to your management team? Do you want to do a stock redemption plan to one key employee or two key employees or something like that? There's a lot of options. And so we need to bring those two things together. I've already talked about diversifying the wealth. We're going to, as the business earns more money and you're able to earn more money in the process, we need to make sure that we avoid inflation in your lifestyle. Because at some point, if the business swings the other direction or you have a down cycle, your lifestyle is going to be up here and the cash is going to disappear. Now it's going to create a lot of conflict. And so we want to make sure that you're managing your lifestyle appropriately, whether the business is going up or you're in a down period, because what we don't want in the down period, the business is already going to have high financial stress. We don't want you personally to also then have high financial stress because then you're out of options. You have no ability to make decisions because all you can think about is how you don't have the money you need, and it's going to slow you down from being able to fix whatever's happening in the business or to figure out a new way to diversify another stream of revenue or to bring on a different product line or to adjust things in your staffing to make the business run well and get yourself out of that down cycle. You need to have a clear head so you can have the ability to think through options. Again, be strategic as an investor in your business about what you're doing and what the business is performing like. So that's very important. We want to use income smoothing strategies to avoid personal financial strain. That's how we do it, right? So we say, this is how much income you have. If the business is on an upcycle, and if you have your cash reserve, and if you have your investment in place, and if everything is running well, and if you've taken care of the people who are helping you build the business, and there's money left over for you to take an extra distribution or a bonus or something like that, cool. Let's not build your lifestyle around it. Let's have that be fun money or vacation money or the money to fund this other investment over here that we want for you personally. Let's not have your lifestyle creep up because you've seen this bigger bonus come in. And that's true for anybody. We don't run our budget on bonuses. We run our budget based on what's the revenue that we have coming in, what's the fixed amount of revenue, cash flow, right? What's the amount of expenses, fixed and variable, or discretionary, non-discretionary, right? What do we have to spend? What do we want to spend? All of that. Let's put those things together and not run it on a budget. And then eventually the way that all of this works, if we're doing it the right way, is it's going to prepare you for the eventual liquidity events of how your business transfers, because you'll get paid from that as long as your business transfers successfully. And so we don't want that to be involuntary. We don't want you to be forced out of business. We don't want you to be forced into early retirement because of an injury or a partnership dispute, or the inability for the business to continue to earn money, or for the debt load to overweigh the business, right? So we don't want to force you into retirement early. We don't want you to get laid off from your own business. And so all of this work helps us prepare for that. And then finally, as a part of that, and I talked about this a little bit in the last episode, but we have to implement financial contingency plans to ensure that there's continuity in how we do your legacy planning. So again, we're going to do estate planning personally, but the estate planning components include what happens to the business. This is really funny. About a week and a half ago, my wife and I go to lunch with one of my clients. They've become great friends of ours, and he's an estate planning attorney. And he was like, "Hey, so I know you're going on this trip to see this client, and you're going to be in an airplane. And what do I do? Like, if you don't come back from this trip, or if you get hit while you're riding your bike, or what? Like, I'm just curious. Like, what do I do as a client? Who's going to step in your place? Who's going to help me continue to do what you've put in place?" And I was like, "Yeah, that's a really good question, because I'm still a solo advisor. I have in the past identified a couple of advisors that I wanted to try to partner with, but under my good influence of how great the world is, running an independent RIA firm, they, instead of wanting to partner with me, went and started their own independent RIA firms, and I'm happy for them, and they're wildly successful at this point, and it's fun to watch." And I said, "Yeah, I really need to. This is a nagging thing that I need to solve in my business." And he looks at me and goes, "Hey, advice goes both ways. So I'm an estate planning attorney. I know you have your will and trust and POAs and all that stuff in place, but how can I help you identify somebody that can step in to your business and take over your accounts? And, there's a line of passwords and things like that. So how can I help you set that up?" And I thought, man, this is really great. I love that advice goes both ways. And so as a business owner, you have to have a contingency plan. Dale Schaefer, you need to have a contingency plan. I keep saying this to myself. And I think, by the way, just for full accountability, you as a listener or someone watching this, hold me accountable too, because I can't just, preach from the chair and then not do what I'm telling you to do, right? I have to eat my own cooking, as you will. So hold me accountable. But I think I have this figured out, and I got to put it in place. And maybe in another episode or two, I will tell you, all right, I took care of it. Here's what I did. So let me have that as a takeaway. Does that sound good? All right, perfect. I love this accountability stuff. It's very helpful. So, and you can email me, or you can go on the website, call me, whatever, text me. However you want to do it, and just be like, hey, buddy, did you figure that out? Did you do it? Did you do what you told me to do? Are you running your business like you're telling me to run my business? Hold me accountable to it. I think that's very important. So, okay, perfect. Have a contingency plan. It's not just about insurance. It's about ensuring your business and family don't stall in your absence. And that's one of the biggest things with this conversation with our friend, the estate planning attorney, is I know that if I were to leave the podcast studio and something happens to me, Melissa gets life insurance, but she doesn't get to capture the value of the business because there's nobody to buy the value of the relationships that I've built or to step in and continue to run the business and provide some sort of cash flow to pay her out. So that's one of the things that we need to make sure that we're taking care of. And so that continuity plan needs to detail operational, leadership, financial protocols in case of an emergency. So think about this. I made this maybe last episode or the one before. If you have a natural disaster, fire, flood, earthquake, tornado, hurricane, something like that creates a catastrophic loss, your building goes out. The power is out for 5 days. You lose your, half of your fleet because of a tree fell onto your trucks. Just think of all the possibilities that can happen with your business and in a natural disaster. What do you do? What's the plan? How do you stay operational? How do you make sure the business stays open? It stays able to serve your clients. You can hold your pre-scheduled appointments. You can continue to deliver on the things that build revenues. So you've got to have an emergency plan in place. What happens if your business gets hacked? What do you do, right? Who's the first phone call? So you want to have these things in place. Buy-sell agreements that are funded are very helpful, especially if there's partnerships or if there's a key employee that you want to have stepping in your place. And then how that gets funded, because what you don't want to do is write a buy-sell agreement with somebody and then there's no money to execute the buy-sell when something happens. So life insurance is often a great way to fund it. Sometimes an investment account can be the backstop to fund it. Sometimes a portion of guaranteed cash flow can be the way to fund it. But you want to make sure that if you have a buy-sell arrangement and one of the participants in that plan passes away or is incapacitated or can no longer serve in the business, their shares need to be purchased from them and from their family. And so there has to be money to do that. The personal estate plan needs to be in place. It needs to reflect business ownership. It needs to be appropriately tied together. That doesn't increase your legal risk or your financial risk, because we don't want your personal estate plan or your personal activities to accidentally pierce the corporate veil and cause you to lose your liability structure or your liability protection in the business. And so that's very important. And then we need to identify and develop a successor, a new leader, develop your management team. The building I'm sitting in now is a commercial painting company, and the owners of the business continually build into their management team, and they're teaching them how to be leaders, how to run the business, how to understand profitability, and they're doing a very good job with it. So you need to do that with your business as well. It's very, very helpful. Don't have managers in place that you just ignore. Don't have people working for you that you don't know. I understand if you have a business where there's 2,500 employees, you're not going to know every employee. I get it. But the people that you're going to spend time with, the people who report into you, know them, develop them, lead them. That's your job as a leader. And then finally, consider any legacy goals that you have: charitable giving, family stewardship, wealth transfer to other people, other family members, things like that. Let's just have a plan in place, and that's going to be helpful. So again, this is the secure. I said it was very detailed. It is complex. It's the most involved stage because we just have to do a lot of really dig in, kind of dirty work to make this work out well. And again, the key areas here: develop strategies to scale while maintaining financial stability. Next, identify opportunities for reinvestment. Third, secure a diversified wealth plan that protects against over-reliance on the business assets. And then fourth, implement financial contingency plans. So this has been a longer episode. I'm going to kind of wind this thing down. So again, as a business owner, as I've said for the past couple of episodes very emphatically, and I said earlier in this one, the traditional financial advice model is not built for you. The boss method solves that problem. And so the reason why it's not built for you is because your asset's not sitting in a capital market account. It's not invested in the stocks and the bonds and all the other things. It's your business. And so you need a financial advisor who understands how to help you manage your business assets so that it feeds your personal wealth goals and wealth building goals and wealth transfer goals. And the boss method is the way that we do that at Life Moves Wealth. It works very, very well. It's very involved. As I said, the conversations are different because when I have a meeting with my clients, I might say, hey, just, your year-to-date rate of return is this. The stock market's been funky this year. The Fed, the president, tariffs, China, whatever. All that's happening. Fantastic. Here's what it was a year ago. If we're looking at it, here's your performance over the past, 3 years, 5 years, whatever the time frame is. No change to the investment strategy. I'm watching it closely, but I still like where we are, and that's that. Okay, let's talk about all the other stuff. And that's how the meetings go. We spend maybe, 5 minutes on the investments. You might have some questions, but we'll spend a lot of time there because it's not where the value of our relationship is. The value of our relationship is in everything else that's happening in your personal life and everything else that's happening in your business life and how we're tying those together. At Life Moves Wealth, we do it the right way. The boss method is how we approach that. And I would love to talk to you more about that. So feel free to send an email to info@lifemoveswealth.com or go to lifemoveswealth.com, click on the schedule time with me button, and let's get started on doing your personal and business financial planning the right way, the only way it should be done, together, integrated, moving in the same direction, strategic. And so let's do that. That's what I have. So next week, we're going to talk about the final S in the boss method, which is succession. And this is going to be all about how you wind down your involvement in the business over time, your exit strategy. We always want to begin with the end in mind. So even if you're starting your business now, start thinking about how you want to make an exit at some point. We reserve the right to change our minds, but we need to have a plan that we're working towards so that way we know what to do next. So that's it. Until then, have a great week. This is Independence Week. I know, in podcast land, you're not supposed to date yourself or whatever, but hey, man, this is the United States of America. Let's celebrate our independence. Let's celebrate what an amazing country we have. There are probably going to be, I've heard people protesting, Independence Day because we're mad at America, and it's no, your country deserves your patriotism all the time, and your government deserves your patriotism when they deserve it. And that's a Samuel Clemens quote, or Mark Twain, as you may know him. You're always patriotic for your country and only to your government when they deserve it. So if the government doesn't deserve it, fine. Don't protest this great country, because this is a great country, and I want you to go celebrate it because I love my country. I love our flag. I love all the things about it. I've recently been watching on Amazon Prime. There's good 3-hour or 4-hour series on several of the presidents, and so I've watched the George Washington one, and I've watched the Theodore Roosevelt one. I'm currently watching the Ulysses S. Grant one, and there's a Lincoln, and there's an Andrew Jackson, and these are great things. So it just, every time I watch these, I just go, man, these guys really, really, really did a lot of work to continue to push the American experiment forward, and we should honor them and honor this great country that we have. So go enjoy Independence Day. Come back with all 10 fingers, please, and we'll see you on the next episode. Take care. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.